So buyers make better sellers, always, 100%. And so if you ever want to sell your agency, go buy two and tuck them in, small ones. You'll have more value, not just the scale that you acquired. You'll be better at selling your business because you've bought.
Welcome to the Agency Profit Podcast, a show dedicated to going deep space on agency operations, which is just as nerdy as it sounds. I'm your host, Marcel Peter. I'm the CEO of Parakeeto, a firm that helps digital and creative agencies measure and improve their profitability. Join me as I interview some of the smartest thought leaders and agency owners in our space and go deep into operations, metrics, and all the other things you need to get right so you can spend less time worrying about operations and more time executing on your vision. Hello, everyone, and welcome back to the Agency Profit Podcast. I'm excited today to be joined by a fellow bearded person who is very into the thing that I am super fascinated with, which is mergers and acquisitions. Peter Lang has been an entrepreneur for over 15 years. He's built, exited companies, acquired many, many more, and is now really dedicating himself towards mergers and acquisitions, both doing that on his own and teaching other people how to grow their business through mergers and acquisitions. So I'm very excited, as I always am, to dig into M&A here on the show and get into the weeds. So with that, Peter, thank you for making the time to be here today.
Oh, thank you for having me. I will say, just to point out, your beard is really nice too. It's much better beard than mine.
Well, it's a little bit long right now, but it's recently groomed. So I appreciate you saying that. I want to give you an opportunity. I've described a little bit of what you do and who you serve, but I'd love for you to be able to describe that in your own words.
What I do now is very different than what I imagined I would be doing as an entrepreneur, but it's exactly what I wanted to be doing when I was in university, which is I have a holding company. That holding company primarily invests in assets. And part of the asset class that I come from, also invest in, is agencies. And so that lends itself to a few things. One is how do you become good at something? You do it yourself and you teach others how to do it. I also have a book coming out, which is my manuscript of how I've acquired, grown, scaled, divested assets and how I can teach other small businesses and SMEs, small to mid-sized enterprise, how to do the same. And I don't know if you know this, Marcel, if you publish a book, you want people to read it. So that requires visibility. So my team, my marketing department has worked really hard to help extend the reach of the frameworks, my approaches, my experiences that I've had, but also my students and mentees. And that's what I'm focused on now. My Misogi for the year, get the book published and launched at our November event that I'm hosting. And it's an ordeal to publish a book. I don't recommend it.
It is a lot of work. I had 3 people that helped me the last time that I wrote a book. We all wrote it together and it was still a massive, massive pain in the ass. So kudos for seeing that process through. It's very long and arduous. Yeah.
I started in 2021. So just
okay. So we can officially say that writing a book has been harder for you than acquiring a business.
Oh, acquiring business is so much easier. And it's type 1.
Okay. Well, we're going to get into that today. Before we do, you started in the agency space, running an agency, and you kind of have a wild story in terms of how you got interested in M&A, and then you sort of dove headfirst into it. So just so everyone has a little bit of context, what got you into mergers and acquisitions to the degree that you now have sort of dedicated your career to it?
Yeah, I was very fortunate to be inspired at a young age. I didn't know what it was, but I was watching Pretty Woman, Thomas Crown Affair, and watching everything that was kind of M&A oriented. And I was like, I really like that side of business. And I went to business school. And in business school, there's a few tracks you can choose. I was international business and corporate finance from a just education perspective. I studied abroad in France and had some great access to CEOs, prominent people. And they were telling me what a CEO does. Marcel, surprise, M&A. CEOs in conglomerates and big companies focus on the external stakeholders. And so I was just hooked. I was like, oh, the job of a CEO is to go out and do M&A. But I just can't be I can't graduate from university and go step into a CEO role in some big company. There's this maturation process, professional development. And at the time I had a blog. So this is the good old days of internet. And that blog had 1 million monthly visitors and had ads on it. And people are asking me, how did I, generate traffic? I said, well, you have to have a blog. People didn't have blogs on their websites at that time. And I was speaking at events while in university about social media. With the early days, Gary Vee, a lot of people were starting at that time. ProBlogger was transitioning from blogging into social. You had social media marketing world. You had just a lot of things I didn't know. I came from business. I was probably going to go into investment banking. And yes, I studied marketing, but I also had a hobby that I was this internet stuff, this website stuff, and I could build them and I could generate traffic and I could write content. And people were saying, okay, well, you've done this for yourself. Can you do this for me? And I said, well, I guess I could. And so I took a few jobs and I was speaking at events, and that led to people wanting to pay me to put a blog on their website, or I became an accidental agency owner. And I started an agency with two other business partners. The other one was a CFO, no agency experience. And the other one was my future wife, my girlfriend at the time, and she's double degree, international business and economics. None of us had agency experience. And we started an agency. So the barrier to entry obviously is quite low for starting agencies. And we were a digital agency in 2010. And so we got to ride an expanding market there. And so I put the M&A stuff kind of on the back burner. But Keegan Larson, who is our co-founder, he and I did investments together. We actually took all of our finance classes together. And so any money we make, we were talking about investing that. We were talking about also learning about other businesses, because we were both Warren Buffett fans. And the general thesis is invest in businesses you know. And so we just continued to deepen our understanding of businesses by servicing them in social media marketing, digital marketing as it expanded, and then, of course, web. So we were doing a business while continuing to foster our interest in investing in M&A. It took a while before we got the courage, though, to really do it ourselves.
And then I think I remember this story correctly, in that you got a phone call from your accountant one day that basically said, like, hey, one of our clients just croaked and their agency is going to dissolve if somebody doesn't buy it. And that sort of pulled you into doing an M&A deal in a bit of a strange circumstance. But if I recall correctly, that was the domino that sort of like started you getting really into doing a lot of deals very quickly.
Yeah, it was definitely where I learned the definition of motivated seller. So because I came from corporate finance and just general business, I looked at everything very transactionally. And I didn't really understand the personal elements within businesses. And my wife and I went on a sabbatical in 2018. We were out of our business for 8 months. We came back to a slight mutiny because we were coming back with the intention to grow, because it ran without us, but it didn't grow very much without us. And we said, okay, we're back after 8 months of traveling. We're going to do these things with the business. And people were like, hey, it's been fine without you, Peter. Vanessa, it's been fine. And so we ran a change management program, which is, corporate speak for terminating people, getting people who are on board with what we wanted to build moving forward. I did a small acqui-hire deal that summer of 2019. And then this was August of 2019. Al Martino phones me up and says, I know you're acquisitive. He's like the old CPA, retired investment banker, kind of like mentor. And he said, there's an opportunity. The founder committed suicide. Not the founder, the owner of the business. He had bought it from the founder. And the business reverted up to the 82-year-old parents. And their other son is a quadriplegic. They don't want to do it. This is a lot for them. If you are up for it, you'll double the agency. They're the same size as you, but they won't be the same size as you a month later. The whole thing will evaporate. And that's just what's going to happen with this kind of situation. And so I called the parents, shared my, remorse and talk to them about the loss of their son. And I said, okay, well, I might be able to make this happen, but I have to structure in a way that I'm being burdened with all the risk. And then they were like, well, okay, we're fine with that. And I learned how to structure a deal, which is I'll pay you with what I can keep. I don't know what I can keep. I really don't. I don't have really time to do great due diligence. I'm going to go through all the shared accounting details that Al's going to give me. I'm going to talk to the office manager and talk to the team, and then I'll fly there. They have an office. I'm fully remote with my company, and I'll troubleshoot it. And so I learned like this just deep dive into a business, and the offer I made to them was, you don't even have to worry about it. I got it. I'll just take care of it. I'll wind down the office. I'll delete all the records. I'll purge 39 years of history. I'll go through all the filing cabinets. I will take care of all of it. You don't have to worry about it. And that was what they needed. And so they accepted the deal. And I structured in a way where I didn't have a downside consequence. It was either going to be creative, but I doubled the agency in 7 days or so. And then people say they can't do deals, or they don't know. They're just not talking to people. They're just not having conversations, right? These things happen. Partnership disputes, there's always things that happen. And even these might not be the most groundbreaking transactions that you typically would hear in the marketplace. But if you're spending time meeting people, you hear their stories, and that's how deals get created.
So that was sort of the first deal. And you would go on to do many more deals inside of that agency. And now zooming out, you've done many more deals in other structures through funds, and you've taught hundreds of people how to do deals. Just so everybody has a point of reference, like how many M&A deals have you been involved in since that time?
As of February 2026, I'm at 21 transactions.
21 transactions. So that's
those are my transactions. And then I have the downstream of students. And I can get into that, but I grew through M&A, which was I learned how to go acquire books of businesses and then hire talent to service that. And I also did other more traditional deals at the tail end of that. And then I launched an investment firm, and on the investment firm, we bought Top Right Partners. And so I went from zero, like concept idea, deploying capital to having 3 million in free cash flow. And I can tell you from someone who built something from nothing, like literally nothing, in building a business independently and then learning all the reps on my own, seeking out advisors in the space to build to something meaningful that took 12 years to get to. It's a lot easier to go buy 3 million of EBITDA. It's a lot easier to go buy it than to build it. I will say, I don't say M&A is for everyone. I do know, though, if you run your own small business 3 to 6 years, you've been an entrepreneur, even if you had a professional career before that, you probably have what it takes to have the next meaningful extension in your career, which is the highest vocation is private equity. And it's just the buying and selling of private assets. Why not use the asset you have to learn the skill that is the most valuable skill you can learn in your entire professional life? And de-risk it, because like Warren Buffett says, buy things you understand, and you understand your own business. So I did that. Although I bought other things outside of the agency ecosystem, although I have other investments, my whole personal brand is in line with my personal journey. And I speak to that founder, because I also know that us as agency people, we like solving problems. We like the variety of client problems and complexity of technology disrupting our offerings and our services. We're just well equipped for M&A. And so now I'm evangelizing that. And I committed this year with the book coming out, which is my manuscript of how I've done this repeatedly, then how my students have done it. And I've been doing this and teaching this since 2021, Marcel. The students I taught how to buy have bought many businesses and have sold for higher values because they bought. And so not only did I have my own journey in the manuscript, I also have my students and my mentees. And so I've become very polarizing and opinionated about the priority of it.
So, we're very much aligned in terms of this. Like capital allocation is sort of like, it's just so interesting. The longer I'm in business, the more I realize like all roads just lead to M&A at the end of the day. And I'm interestingly also like at a point in my career as an entrepreneur, I'm about a decade into being self-employed, where I'm starting to make that transition myself. So I'm very much bought into this. Now, the question is, I know a ton of agency owners, I know a ton of entrepreneurs that have all the skills. I think a lot of people intellectually can understand that this is a huge opportunity. It's pretty obvious when you start looking at it. Why then, Peter, do so many people still not go through with this process of actually doing M&A to grow their business or to take that next step in their career? What holds people back?
It's the same as growing muscles on the body in fitness. You have to break it in order for it to grow. And so you're asking people to break the thing that is currently providing for their families and for themselves. It's a very scary concept. They also don't have enough information. Like anything is hard the first time you do it. And if you don't know how to do it, of course it's hard. Those two combined are not in the favor of someone taking action. But there's two things that motivate people: inspiration to be better than they are, or pain. And a lot of people just haven't gotten there. And then from my experience being teaching this, there's a lot of aspirational business buying. There's a lot of aspirational success. And people just don't show up with the discipline every single day to do the things that they need to do and they know they need to do. That's it. And it's just normal. Like there's a reason why you have high performers and the rest not. This is a very powerful strategy used by almost every successful organization that you're just not taught how to do it in entrepreneurship. Because it's not entrepreneurship. Although there is an MBA course called Entrepreneurship Through Acquisition. So the fact that people say, oh, I have to have 10 years of career experience. There's people who go to get an MBA and then go buy a business and become a CEO overnight of a business that's generating $1 million to $3 million in profit. And they're straight out of university, no career experience. So there's plenty of people who are doing it. You just have a false belief in yourself, and you're not in a room where this is the norm. It's like running a marathon. People go, I can never run a marathon. Well, if you're around a bunch of people who run marathons, you start believing you can. And it's the same thing that goes with this. You got to be around people where this is par for the course. This is now accessible and also probably less risky than the thing you're doing today.
All right. So you're touching on some, I think, the limiting beliefs that come up a lot for this. And so I'll project some of my own onto you and then some of the things that I hear from my peers. So the first is risk. This seems really risky, right? What if I acquire the business and it doesn't work out? I lose all my money. It tanks my business. The integration goes poorly, right? So there's a lot of people that see this as being a high risk endeavor. What is your response to that fear?
There's two classifications, and you can use the two words for it, but you used them interchangeably, which is where I would push back. There's risky behavior and there's risk. There's risk in everything. There's risk in driving a car. There's risk in everything. And so there's risk calibration that probably needs to happen. Risky is climbing a mountain with no rope and no experience. That is risky. But like pragmatic risk, the same risk exists of injury, but you can mitigate that risk by training, being prepared, having someone who's done it before take you, by putting in ropes, safety measures. There's risk mitigation. So when people use risky as a replacement for risk, they just are misinformed. So the first thing I would say is there's much more education that's needed because it's not risky. There is risk, and that's why there's reward. It's why there's reward. It's definitely a consequence. You definitely are going to break the business you operate today. That's how it grows. Your business doesn't grow by staying the same. You don't grow by staying the same. And so you have to break it. And that's a risk. And people don't know how to quantify that risk and how to mitigate it. Therefore, they can't commit. They can't jump the chasm. There's no bridge for them. And that's why I really focus really heavily on educating that. And kind of revealing the black box for what it is. It's just false beliefs, lack of effort, lack of trying. And even the people who try, there are things that people are more suited for or to than others. Like I don't have the body of a swimmer. I don't have the body of a pro athlete in NBA. You know, there's certain things that you have limitations that you can work with, but other things that are easier for you. This is not that extreme. But there are things that people are more, their risk tolerances are calibrated differently. Maybe they grew up in a family that had a negative language around debt. They didn't think of debt as a resource, whether that be seller finance or traditional, lending or banks. They don't really go into the deep around the business. They're a service provider. There's a bunch of things, Marcel. At the end of the day, for you, if I just respond to your specific question, we just have to make sure anything that you've identified as a risk, you list it out in it's called questions to resolve. You list out all of them and go line by line and address it. But unless you do that exercise, it's called in risk mitigations, it's called questions to resolve, you will never take action. And if I ask you right now to pull up your calendar for all the listeners, and I say, what right now in your week, I'm using you as a pseudo proxy for this, but what right now in your week is going to add $300K in profit to the business this quarter? Maybe you have an internal initiative. Maybe you're growing that way, but an acquisition can do that. You can do that every quarter. So show me on your calendar, founder, agency owner, what in your week, what in your month is going to add 300,000 in profit to the business and increase the multiple, the enterprise value of the company on when you sell it. If in your calendar you do not have anything that's going to contribute to that, that's why you're not doing it. That's why you're not going to realize the gain, because you're not even allocating time.
So you've touched on, I think, the pin that exposes what comes after, like one of the big things that gets talked about a lot is like the belief that you have to have a lot of money to do acquisitions. And I think we've talked about it enough on the show that people understand that's not really the case. You have seller financing, like there's all kinds of creative ways to finance a deal. But then there's diligence and there's integration. And I think this is where there's a lot of fear, uncertainty, doubt, integration in particular being the one that feels very important. What are your best practices in terms of making sure that like those two critical steps get handled in a way that is most likely to result in, good outcome?
So out of everyone who teaches business buying, I'm probably the most vocal on preliminary due diligence, and integration planning. Probably the most. And so there's a stage prior to an LOI called preliminary due diligence. If you go through brokers or you go through other people, they don't have this depth of preliminary due diligence. I do, because where risk lies, that's value. So if there's high risk, the value goes down. And then most of the value from a transaction is what happens after close. So if that's where value creation happens, your whole deal thesis is everything that happens after you do the deal. And too many people are like, oh, doing a deal is this big thing. No, doing deals are easy. Due diligence and integration planning and integration is hard. That's the hard bit. And the people who are the deal makers aren't usually the best integrators. Gino Wickman, visionary and integrator, right? It's the same skill set. The person who's the visionary who can cast an opportunity for a seller under this new business, right? That visionary isn't the detailed operator integrator to go through line by line every item in due diligence and then map that to a pragmatic, flexible integration plan that's going to be 6 months to a year, right? So I'm probably the most vocal to that. In agencies, what are we really selling? What are we really buying? We're buying contracts. And we're hiring the people, because you can't buy people, by the way. So you have to offer them jobs and hope they accept those jobs at the new place, unless you buy the entity that they already operate in. The vast majority of the time, you're just assuming the contracts that this business has locked in. And then you're offering jobs to the people and hope that they come over in asset deals. And so, again, you have to do a lot of review of what's the quality of those contracts, what's the quality of those relationships, what's the lifetime value, what's the true utilization of that client. And then what people always get into, like, client concentration risk. They go, oh, if their client is 30% our revenue. Well, it's probably more, or even more, your profit. So client concentration to profit is often really interesting, but most of the time you don't see that data point. One client that's bigger might be more profitable than 8 other clients because it's so efficient. And so that one client can actually, then it could be the opposite. Yeah, this is why you have to go in very specifically and evaluate that. The good news that I give to agency, if you're a business owner today, as soon as you become a buyer and start scrutinizing and criticizing and reviewing other businesses, you just turn the mirror on yourself. You can't help but get better. Even if you don't buy, just go and reviewing and getting almost to a few deals with some sellers. You'll go, oh, if I flip the script on me, can I hold water to this? So buyers make better sellers, always, 100%. And so if you ever want to sell your agency, go buy 2 and tuck them in, small ones. You'll have more value, not just the scale that you acquired. You'll be better at selling your business because you've bought.
Do you want some free resources to help you measure and improve your profitability? If you do, then I want to tell you about our agency profitability toolkit, which you can grab absolutely free in the show notes or by heading to parakeeto.com/toolkit. It's packed with training videos, cheat sheets, templates, and all kinds of other great resources to help you start measuring and improving the essential metrics that are going to drive better profitability in your business. And it's helped thousands of other agencies around the world do the same. So I want to encourage you to go and grab a copy of that. And if you'd rather get in the fast lane and just have our team of experts guide you through the process of measuring and improving your profitability, then I want to encourage you to apply for a consultation at parakeeto.com. With that, I want to thank you again for tuning in. I hope you enjoy the episode, and I'll let you get back to it. So one of the things that you touched on here was, integration and the timeline around that. And I've heard you say this on other podcasts, culture fit, is just as important, if not more important than the numbers that are showing up in the spreadsheet. And I imagine that really comes into play when you talk about this integration. Are the people going to come over? And then how well is that integration going to end up going? Because a lot of it is people and change management. How do you suss out culture fit in that due diligence and pre-due diligence process?
Yeah, so it's really interesting. So I want to step back before that, which is, as your own business, do you assess culture? Like, don't do to other people if you haven't done it to yourself. Like, at the end of the day, if you're running a business and you're 10 million in revenue, 2 million of EBITDA, 20 million, 2 million in revenue, and 200,000 in profit, if you haven't done culture assessments on yourself, it's going to be really hard for you to see it in others. So I'm going to get into things that elite buyers do, of course. But if you haven't done it yourself, again, it doesn't make sense. It's about mapping. It's about porting over, okay, they have this culture. It's quantifiable through this evidence, through these assessments, and ours are this. Therefore, the probability of matching those two is this. If you don't even have it, how can you map it? So first prerequisite, map your own culture. Enneagram, DISC, Myers-Briggs, do those things, and then do that in due diligence on the business you want to buy. And then even though you fell in love with the deal and you even had a signed LOI, if it doesn't match, walk. Like, that's why it's a high priority due diligence item in my standard operating procedure. Like, you got to do financial, so Q of E, and cultural confirmation in the first 2 weeks post-close of an LOI. Ideally, you do it pre-LOI, but a lot of sellers are unprepared and they don't want to commit from the investment perspective until you have deal structure and terms. So that's why we prioritize those in the first 2 weeks. But then flip the script on yourself, Marcel. Like, think of all the agencies you know. How many of them could present to you, if you asked for it, quantifiable evidence to support the culture and the values that they state are true about their business? How many? Take a guess. Half? Less than half? Yeah. So realize you probably go to a seller and they don't have these things yet. Have them do it. Net promoter score. Oh, we don't do it. Do it. Do it as a part of due diligence. Report back to me. NPS. You don't do it. Do it as part of due diligence. eNPS. Employee net promoter score. You haven't done it? Do it in due diligence. Show me the answers. Oh, I'm afraid. You're afraid to ask if they will renew with you, if they like. That makes me feel very confident that they're going to come to me after the fact. Like, part of due diligence is also the opportunity for a seller to improve its business. Because the things that really make them more valuable are the things that are discount factors too. So they should address them. But there's just quantifiable ways. So, Marcel, my first advice is measure it yourself. And then, Marcel, my favorite question is, do people leave companies or do they leave their managers? They leave their managers. Yeah, they leave the manager. Yeah. So at the end of the day, who they report to is more important than the company. And so when you do these quantifiable assessments of culture, then you have to do role matching in your employee census or in your org charts. And to increase your probability of stickiness of integration, you need to match people based on cultural fit, as well as the system that they operate within. It's a science. Anyone who says deal making is pattern recognition, it is semi-craft, and all that is true. Like, you do enough of them, I'm sure you have pattern, but it's still a science. You still have a way to go through. And just like I said, from a risk mitigation perspective, list every variable and give it an answer. But most people don't spend the time there. The same way, like, fitness is easy. It just requires discipline. Managing your financials is easy, requires discipline. These things are just asking a lot of people, and in their lives, and they have kids and their families and businesses, it just gets pushed down as a priority. Proximity to a problem makes it a priority. And because this thing doesn't exist for them yet, it doesn't mean anything to them yet.
With all of this being said, I want to shift gears a little bit and talk about timing. the last decade or so, the narrative around M&A has been that we have this generational transitioning that's happening, where you have a large contingent of baby boomers and people that owned, a whole generation of businesses across every industry, agencies, professional services being the same, that are looking to retire and they're looking to move on. And so there's this massive vacuum of sellers versus buyers. So that's been playing out. And now I feel that there's another dynamic that has entered into the picture, which is the emergence of AI. And I think this looming idea that like everything is changing and is going to change. And I think that there's very much a divide of agency owners, even if they weren't necessarily at retirement age, of like, do I want to get on that bus and deal with all of this change and reinvent this business once again? Or do I not want to do that? And I think that there's a good swath of people that are like, I kind of want to get out of the game at this point and go take a job or go do something else or whatever the case might be. And so all of that, I think, is creating a context where there is a ton of opportunity right now. If you're in the camp of, I'm ready to take on this change and be on the cutting edge, and like, I'm excited about this transition to grow through acquisition, as you've mentioned. I'm curious what your take is on the current state and how it's affecting M&A, and maybe how it's affecting your, how you're viewing deals. Yeah.
So to give some labels to this, it's called the Great Wealth Transfer. And what this means from a economic perspective is there's an estimated close to 84 trillion to like 100 trillion plus expected to move from baby boomers and the silent generation to their heirs. And that's going to end somewhere between 2045 and 2048. And so this massive shift of this aging demographic who reaped some positive wealth progress post-World War in physical assets, that's real estate, and also in securities and the stock market, and also in the businesses that they had. They need to go somewhere with that. And the way we used to transition assets, just to kind of set the table, was succession through family and heirs. And if there wasn't someone within the business would step up and sunset the owner out. So they would then pay that owner out over a period of time through an earn out, almost always. No one used debt in the same way that you would in because most businesses just wouldn't survive being levered up that way. And so it'd be, we're going to pay you a percentage of the profits to a certain valuation so you can go retire. And we'll take over the business. That was normal. And so you have this huge transition that needs to happen. It's going to happen. You either can have it happen in a smooth and thoughtful way, or it can be a hot mess and assets get dropped, value gets dropped, the economy gets hit by it. And something like 40% of the US GDP is made up of small businesses. And so you couple all of that with what we always have had, Marcel, which is AI disruption or technology disruption, or there's always been something. Technology's always showed up and caused disruption to what we've been building. And so it just feels close because of the present moment, but also the threat within the sector we operate is a little bit higher. The sensitivity's there. So people don't have a choice. People don't have a choice. So the first thing I want to say is AI is coming. Everybody will use it the same way we're on a Zoom, we're remote. The pace by which they accept it is the adoption curve for sure. They're choosing, but they don't get to opt out of AI. AI is already there if they have an iPhone. AI is already there if they use the internet the way that they use it. It's just whether or not they want to spend the time and energy on their current business to be competitive in that different ecosystem. The same worked with websites. Websites were the department of IT. So information services and IT managed the intranet and the websites. It transitioned, do you know what year to agencies? No, see, the precedent's really fun. So the 2000s, maybe even like 97, the real first digital agencies started showing up, who were independent boutiques who were making websites, and they had creative and advertising backgrounds. But still, the vast majority of the internet was the IT department. So managed service providers, IT services, had server racks and were hosting websites for people because there wasn't cloud hosting yet. So that's why agencies were able to compete in web and digital, because they're like, oh, these IT people have your website. That's why it looks ugly and it's not working. We're going to show up and be a boutique advisor, and we're going to transform it. And then you had this expanding internet. Then, of course, you had the timing of this goes social into mobile, and then those have really become digital marketing now. Then of course you had Amazon, which was direct to consumer through online merchant. You kind of this expanding internet society support. And so now we exist at an age where machine learning has been there for a long time. Versions of AI have been there for a long time. It's now a consumer-facing product, and people can use it the same way they kind of were using elementary or fundamental interactions with their agency. And so it seems like a threat. What has been true for every technology evolution phase is there's going to be people like the roofing company that has a website that needs to be found on some search so they get businesses and they can provide for their employees and their people. There's going to be professionals who need someone else to do that thing for them because they're off doing the job. So there will always be a place for a service provider there. The service will adapt and change based on the tools like they have for us in digital marketing since the 90s. Just the pace at which they're changing. And then what you're bridging the concept, well, if you're in that age where you probably are thinking you would have sold already or should have sold or are thinking about selling, plus this is coming, you have to spend so much of your profits potentially changing the company that it could discount you at the time of which you're trying to liquidate the business. So you're fearful. Like right now I have 300,000 in profit. Now I have 500,000 in profit. Right now I have $1 million in profit, 2 million in profit. But if I have to start doing AI investments at scale to keep up and survive, my profit's going to go down potentially, although there will be gains, right? But then I'm going to fire people and then I'm going to create bad morale in the company, which could disrupt my clients and hurt my money and hurt what I'm working for every single day. Just a lot of fear and uncertainty. And so people get a little paralyzed, right? Paralysis by analysis. They get a little bit like frozen of what to do. And so some are deciding maybe it's best I just wind down. And of course, sure, like the capitalistic market, right? The strong survive is kind of the gist of it. So if you can't and aren't willing to, you should sell. You're going to be selling at a discount because no institutional investor is touching anything without AI. Unless a strategic can buy you, a strategic can assimilate your clients, and then they are burdened with the change management of how are we going to service this for the future? How are we going to build a purpose that can go beyond the next 5-10 years? They're inheriting that risk, and therefore they're going to structure the deal that way. So I say all that to kind of talk out of both ends of my mouth, which is, yes, it's true. Yes, there's plenty of people who should and will tap out, but I'm also very confident there's always going to be a service you can provide people who need to use AI and still digital tools and online and the internet to stay in front of people so they can provide for their employees, get more customers, and provide for their families.
I couldn't agree with you more. It's funny. I've had this conversation a number of times. I'm having this conversation actively inside of a venture studio that I'm involved in that's like incubating AI products. And what's become very clear to me is that the lines between services and SaaS are going to be gone within a couple of years. Everything, in my opinion, is converging on outcomes, and as they should. And I think this line between services and SaaS has always been somewhat arbitrary because every SaaS company is a service company. They just do stuff for free and call it customer success and onboarding and customization and professional services. The monetization model is different. You're just applying leverage to a process using technology. And I'm seeing a lot of venture capital money, private equity money flowing into these plays that are basically buying existing service-based businesses and just levering them up with technology, building a platform, to your point, that can then arbitrage, like buying something at 4x EBITDA, rolling it into something that's worth 15. And every service business is going to have to adopt AI. And so like these paths are sort of starting to converge, and it makes perfect sense to me.
I push back. Rory Sutherland says this better than I do, so I'm going to butcher it, which is the system that you operate in builds constraints. And so what agencies are really good at doing is not assuming the constraints in their problem-solving approaches. So being a service provider is not being a support agent. So agencies who transition to result-based engagements, or what we call value-based selling, are not commoditized and would never shouldn't be replaced by support teams within software companies. And the reason for that is really simple. The personnel you have in the support role is a very different person than the one who wants to be in an agency and solve problems for 30 different clients in economically meaningful ways. Additionally, the support role is at threat from AI too. Support's being automated more so than problem solving is being automated. And so it's really interesting if you think of that as like a bridge gap, which is I don't think it's going to be as easy. I'm a little bit more into Rory's camp, which is the people who are the best problem solvers survive. And your job is to use whatever's available to you to problem solve, and that's not always support.
I agree with you completely. I think we're saying the same things just differently. For context, like when I look at the SaaS landscape, the seat model tool, like all of that is going away, right? So every point solution, SaaS feature, whatever, is all just going to be a feature inside of Claude. And so all the SaaS companies that want to survive, they're actually moving away from this kind of seat-based support, tool feature to selling outcomes. And so like they're all actually leaning back into services, which is really fascinating to see, while service-based companies are all leaning into technology leverage. And so you see them kind of both leaning towards this middle point, which I think is kind of like the ultimate outcome that was always supposed to be there, which is like you sell an outcome to the client and that's what they buy. And they don't care how it gets done. It's just like, can I give you $1, solve a problem and get a higher return? It's just like pure economic synergy. And it's just fascinating to watch this happen.
Yeah, the challenge we have, and we could debate this for a long time actually, which is competition. So in economics, there's a scarcity component, supply and demand. And so if everybody can do the same thing, how do we survive? Right? It just doesn't make sense at a certain point when you play that out. So it's if every SaaS company competes with services and every service company becomes a SaaS, you won't be able to differentiate when there is a differentiation. Candidly, Marcel, me and what I'm capable of doing is very different than someone who maybe looks like me in the market. And so how does someone, a consumer, tell the difference? They can't. They most likely can't. And so there's still going to be a need for how do you differentiate when everybody's been blended together, when you can't distinguish it because they're all using similar tools and similar languages. That's the solve for the agencies. What I think agencies can lean into who are listening to this is really simple. Your differentiation is how do I help a client outperform the competitors? Because that's the value creation. We're back to Pepsi and Coke, Marcel. We're back to Pepsi and Coke. We all became friendly with digital. Now we're back to advertising 101, which is you have to pick a side. And if you side with me, we're going to beat the competitors. And we're all using great tools that increase the capability for us to perform. But again, Marcel, if I'm agency ABC and agency XYZ has the same tech stack, same capability because of AI, and the client still needs it, how do they determine which one? They got to pick one because and then the agency lost that client. They're going to get the competitor and they're going to compete against each other because it's still a capitalistic society where you're a PI attorney, you're a roofer, you're trying to earn business and be found. Dentist. There's how many dentists do you drive by on the way to your dentist? Like there's noise of saturation of people trying to provide for their families and their employees. And so there's always going to be this little edge there that is going to exist for easily another decade because you just can't get rid of that. It's just built into our current system so much. So I'm very confident in the agency model. I do agree that everyone should be using AI. They need to be using it personally. They need to be using it professionally, and they need to be helping clients with AI. The same way the agency went from writing copy and advertising that placed on television and billboards to then helping them build a website, which was their own billboard online, that then helped them make that their best salesperson who never sleeps, who then made that something that could reach out to people like cold calling, which was online media buying, and then social media networking. Instead of going to all of the business chamber of commerce events, instead of networking in person and going on the trade shows, you could build a social network that got you in front of people. We've replaced all these things, and agencies helped small businesses do that. And there's going to be a place for that. That's my investment thesis for the next 10 years easily. But we don't touch anything that doesn't have an AI forward approach.
Again, I think we're saying the exact same things, just differently. This is why I always say, just to abstract this even more broadly, like services are the cockroach of the economy. Like they've been around the longest out of any business model, and I don't think they'll ever go away. You can't kill services because it is fundamentally, to your point,
land.
Like if the goal of business is to solve problems, right? Yeah. And by solving problems, you unlock value, and the business is just a way to facilitate the unlocking of that value and the capture of some of it. Everything else is like service versus technology versus they're all just mediums for problem solving. And services, a human being showing up, using judgment, and then just doing something differently as they learn is inherently the most malleable medium for problem solving, and therefore is like so effective at filling the cracks as the economy and the landscape inevitably changes constantly. And so like it will just always, to me, be the front edge of entrepreneurship. I can't see how anything else could be true.
No, 100%. And the thing we can like bookend the agreement on is you have a choice, founder who's listening to this. You can you got to do all of this, but you now know there's founders and business partners with multiple 7 figures worth of books of businesses who are not interested in keeping up. And that's going to be a transition of wealth. So you can either let your competitors go acquire them. And trust me, Strategy Beyond the Hockey Stick, McKinsey wrote the book on this narrative. Over a 10-year horizon, programmatic buyers outperform their competition. So yes, you may innovate with AI, but the agencies that do innovation with AI and buy out all that book of business will crush you, who's just doing the AI. You just can't. They're growing geometrically, and you're growing incrementally. And so which game do you want to play?
So with that, Peter, for those that are listening that want to learn more about the way that you teach, the resources you have for learning about M&A, where should we send them in the show notes?
LinkedIn is really a good place. We try to offer as much education, free content as possible. I'm a firm believer, and I ran my agency with this philosophy: provide value upfront with no obligation.
Awesome. So we'll have Peter's LinkedIn in the show notes, as well as a couple of other spots that you can go check him out. With that, Peter, I want to thank you for your time and for this passionate discussion about M&A. It's a very exciting time, and I really appreciate you coming to join us on the show today.
Thank you for having me.
Hey, thanks so much for tuning in to today's episode. I hope you enjoyed it. And if you've ever found yourself thinking, man, I get so much value from this podcast, I wish there was something I could do to return the favor. Well, today's your lucky day, because you can leave us a review wherever you're listening to this, and it is incredibly helpful. Of course, if you haven't grabbed a free copy of the Agency Profit Toolkit, go and get that. It's got tons of free resources to help you improve your profitability. If you're looking to get in the fast lane and get help from experts to improve your profitability and measure your most important metrics, then apply for a consultation at Parakeeto.com. We'd love to chat with you and figure out how we can help. With all of that, thank you so much for being a listener, and we will see you on the next episode.